Welcome to the Plan Solutions Incorporated podcast, where we give facts and insight on the latest happenings in the world of economics, financial markets, and personal finance. Plan Solutions provides advice on a variety of financial topics, including investment management, tax preparation and planning, and retirement planning. Chase has 25 years of experience in the financial industry, holds a certified financial planner and chartered financial analyst designations, and has earned a master's degree in taxation and a doctorate in business administration. Chase has a passion for helping clients down the path toward their financial goals. And I'm Jason LaChance, and on this episode, stock market opens the year on a strong note. Tax season, time to review tax withholding. Tax season, challenges with new laws, and a look at the Plan Solutions Incorporated office bulletin board. Mr. Armour, how are we, good sir?
Doing well. As as the headline says, it's been a strong start to the year in the financial market, so that's been good. And obviously, gearing up for tax season, it's gonna start getting busy around here.
Yes, sir. Do you get some sort of mental stretching in, so to speak, to prepare for this time of year?
I pretty much just accept that I'm going to be really busy, might have to work long hours, go. And then if I am fortunate enough to get a break, do something enjoyable, then I'm feel lucky, right? Rather than, feeling that you're put upon to have to work those long hours when they're needed.
Yes, sir. Same attitude. Well, let's dive right in. Like you said, stock market opens the year on a strong note. The S&P has started the year in positive territory, advancing 1.38% in its first 11 trading days of the year. I mean, a very positive sign that what we're looking at here in 2026 as far as the stock market, and usually a good economic indicator of where things could be headed.
Yeah, and fortunately, as we're talking here, it's still valid, because when I wrote that, then the market dropped 2% the next day, but now it's rebounded. The next couple of days rebounded, so we're pretty much back to that same level. Which, 1.38% in 11 trading days is really solid. So I think it's a good sign that investors are continuing the trends that came into this year after a strong 2025. And it's always a good thing to start the year in positive territory, because historically, when you've seen a strong start to the year, that's created a higher likelihood that you'll have a good year. Now, as we often talk about, these historical patterns don't always hold. There's a lot of factors, right, that can come into play. But that's what you would want to see if you're hoping for another good year in the market, is that we have a strong start so that it conforms to that historical pattern that we've seen.
Yeah, absolutely. Well, has there been any surprises so far? I mean, I know, to your point, we're as of this recording, we're not yet through the month of January, but are we seeing any real surprises coming to fruition so far in 2026?
Yeah, we're seeing a little bit of a shift in the market, and it started late 2025, but it has definitely continued through the very early 2026 here. And one of the big ones is the MSCI EAFE, which is an index of non-US stocks, is up 3.7% so far this year in 2026. So, well above what the US market has done. And that comes after 2025, where the EAFE was up 31.4% compared to 17.9% for the US. So we're continuing to see this trend of strong foreign stock performance compared to the US, which I think is a good sign. We came out of a very long period of US outperformance over foreign stocks, and a lot of that relating to just the increased value of the dollar. Really from 2008 until early 2025. I mean, we pretty consistently saw the dollar increase in value compared to other major foreign currencies. And that, of course, benefited the US market. But we've seen the dollar retreat from those very high levels this time last year. And that creates this tailwind for foreign stocks, because if you're invested in a foreign currency and the value of that currency is going up, that return is additive to whatever the price changes in those stocks.
Are there any particular sectors that are really driving that as far as non-US stocks, or is it just really overall in a more broad scope?
Yeah, I mean, the foreign versus US question to an extent is a sector question because the US market has become very heavy into tech.
Mm.
Technology represents about 35% of the market. The top 10 companies in the US are a huge percentage of the market. Most of them, I think eight of them are technology stocks. So it's really tech versus other areas. And we've seen a bit of a shift into some other areas of the market. Foreign is going to be heavier in financials. It's also going to be heavier in like energy and other commodity type companies. And so we've seen those come on strong, which has helped, I think, as people are starting to look at kind of the real physical world and investments that need to be made for growth there. But I also think, a big part of it is that dollar trend, right? When people seeing the dollar weaken, they know they can juice their returns by, going outside the US. And even though the weakness in the dollar only added about 6% to the foreign performance, I think that trend just creates more demand for foreign stocks, right? As people are seeing that additive potential return.
Yeah, interesting. And you mentioned there, as far as U.S. stocks, are we seeing anything? I don't want to say that it's an anomaly, but any kind of shift, because you really mentioned that technology, artificial intelligence was a big driver in 2025. Are we seeing any different movements in 2026?
Yeah, the way I would describe it is we're just seeing increased breadth in the market. And what they mean by breadth is the returns are being driven by a larger number of companies. When you have the returns driven by a relatively small number of very large companies, especially in this case, those that are tied to, technology or artificial intelligence, that's not necessarily a sign of a healthy market, right? So you'll remember few years ago, right? They talked about the Mag Seven, the Magnificent Seven, those seven companies that were driving so much of the return. And that's generally not what you want to see. And actually, that was the big catchphrase in 2021, which led to arguably the downturn that we saw in 2022, that we weren't seeing this breadth of companies advancing. And we've seen that shift. Whereas kind of over the summer when we were seeing strong returns, a lot of that was driven by those very large tech/AI companies. But since then, those companies have kind of flattened out. Some of them even, dipped a bit, whereas other areas of the market have performed much better. And one of the ways you can test that is if you look at the S&P 500, that's a capitalization weighted index, meaning the more valuable the company, the larger percentage that is invested in that company. But you can look at the S&P 500 equally weighted, where they take all 500 companies and assign them the same weight, right? So those really big companies are going to be a very small, much smaller percentage of the index. And those really, really small companies that are, within that large company universe, but much smaller than the largest, they're going to have a much higher weight than they normally would. And if you look at that so far this year, the capitalization weighted is, as we said, is up 1.38%, but the equally weighted index is up 3.9%. So it is strongly outperformed because really the leadership is coming from a lot of these smaller companies that are still included in the large company universe. So they're still really big companies. It's just compared to, the few giants, they're much, much smaller. And we've been seeing, I think, a lot of the investment focus shifting more in that direction.
Is that, and I know this is speculative, but some of the headlines that I've read and articles is the adoption of AI technologies, yes, but the monetization side of it lagging behind that. Is that maybe playing into some of these factors around that, being that in 2025 that was kind of a big focus?
Yeah, I think that could be part of it, right? The timing of when these cash flows may come and having to kind of re-underwrite that and think it could be further out than expected. I think there's other ways to look at it as well. When we had the internet investment boom in the late '90s, it was kind of focused around all of the value, the belief that all the value would accrue to these internet companies. But the truth is, it really, was distributed economy wide, right? I mean, so many companies. You think of, traditional banking. I mean, we all bank online now, right? You don't need as much brick and mortar at reduced costs. You see that in every industry. So I think it's also partly a recognition that the benefits of AI really will accrue to a lot of different areas of society, not just to the AI companies. And then the other part is, a lot of these AI companies have done really well. They probably have grown as in terms of the percentage of portfolios. And, periodically you're going to see a rebalance where people are going to take profits in those areas and reallocate to other areas of the market that look attractive, possibly even more attractive in the short term because they're offering better valuations because, the prices haven't increased as much. So it might be a somewhat of a rebalancing, which again is typically healthy for the market because it's showing that investors are finding value in these other areas of the market, not just one segment that's driving everything.
Yeah. Well, speaking of other areas of the market, how about small and mid-sized stocks? Any change from 2025? We talked about them quite a bit. Um, any uptick there?
Yeah, that one is really surprising. In 2025, the Russell 2000, which is an index of small and mid-sized company stocks, increased 12.7%. So that lagged, U.S. large companies that were up 17, 18. But so far in 2026, the Russell 2000 has increased 8% in just 11 trading days. So again, expanded breadth within the U.S. market and seeing money being allocated to some of these other areas where there may be better value. That's a good sign for a healthy market, and obviously, really makes the case for diversification.
Yeah. Well, being that we're about 3 weeks in with all this information and data, we get a little speculative, but as you stated, a market that starts out strong is a good indicator.
Yeah, and so it's a positive. I mean, obviously, a few weeks doesn't make a trend, right? We can't get too excited about it, but it is positive to see the direction that things are going to start the year, and we can hope that those trends continue.
Yes, sir. All right. Well, let's jump into the first of our two topics around tax season. Time to review tax withholdings. Tax season is just not about the preparation for the return, but you got to do your due diligence.
Yeah, it's a great time to start the planning process, and one of the big pieces of that is to try to do some estimates and make sure that withholdings are in line with the expected tax liability for 2026. And I think this year that'll be especially important. I mean, there's the case where if someone owes, right, or they're projected to owe, it's always good to make those changes earlier in the year. Having a little bit more withheld each month is usually a lot less painful from a cash flow standpoint than waiting till later in the year and realizing you really have to play catch up over a short time period. But on the other hand, I think where the focus needs to be this year is in situations where there might be a large refund projected. In that case, it could be beneficial to change the tax withholding to reduce the amount that the government basically gets to hold on to interest free during the year, especially with interest rates being reasonably attractive right now. There's some value to holding on to that money. And I think with some of the tax law changes that we've seen, people might see larger refunds. One of the big ones is the additional $6,000 standard deduction for taxpayers over age 65 who meet the income thresholds. That was a change that was implemented last year. But unlike the tax law changes in 2017 or some of the other big changes, they did not change the tax withholding regime to account for that. So in 2017, when they changed the tax rates, they reduced the tax withholding. So it kind of stayed in line, and people probably saw a little bit more in their take home. But this year, with some of those tax cuts, there was no change in withholding. So people may find their tax liability went down, their withholding stayed the same, their refunds maybe increased to a point where it makes sense to make an adjustment.
Yeah, well, and one thing that you educated me on that people maybe don't get, and tell me if I'm on target here, my logic's just not coming out quite right, is when people go, big tax return. It's like, well, but that's your money that if you got as close to zero, like a zero tax return, would be optimal, because then you could have that money to invest elsewhere and get a greater return on that, as opposed to just here comes a $6,000 return or whatever it may be.
Exactly. Yeah. I mean, maybe you could have earned 3 or 4% in some type of savings account on that money, right? So getting the benefit of it. Or, to the other side where it's the real negative is where you see, somebody gets to the end of the tax year and says, oh, good, I'm glad I'm getting this refund. I need to pay off some credit card balances I've been carrying forward. And then you're thinking, well, now it's not just that you're missing out on 3 or 4%. You may have been paying 18 or 19% on that credit card when you're earning zero on that money that the government's been holding. So you've actually been going backwards at a, much faster pace by letting the government hold on to your money for most of the year rather than you having access to it and being able to make decisions on where to allocate it to benefit your overall financial picture.
Yes, sir. Anything else you would like to add before we jump to tax season challenges with new laws?
Well, just that, I think if you're looking at pretty small refunds or small amounts due, obviously it's hard to fine tune the tax withholding perfectly. But, if it gets into that larger amount, if you do your own taxes, it may be worth talking to someone saying, how does this work? Or, if you're working with a tax preparer and you have a sizable refund, say, what adjustments can we make?
Yes, sir. All right. Tax season challenges with new laws. We have been touching on this throughout the year as a greater understanding of the One Big Beautiful Bill that passed in 2025, all of its provisions, and how they're going to play out and come to fruition. So, where do we really want to dive in with this? What has become clear as you're preparing for tax season?
Yeah, the challenge that's going to be created this tax season is really relates to two provisions. It's the no tax on tips and the no tax on overtime, right? Which both of them are not quite how they sound. There's a lot of caveats and requirements for there to be tax benefits there. But the challenge is that the law really is implemented in 2025. So for last year, when we're preparing last year's returns this year, these provisions will apply. And the way they're set up is it puts the impetus on the employer to report a portion of the employee's income that may benefit from those provisions. The problem is because of the time frame and this being implemented partway through 2025, those reporting requirements, employers don't have those reporting requirements until 2026. So, an employee who may benefit from one of these provisions really might be on their own to figure out, what amount or how they may qualify if their employer is, waiting for that 2026 deadline and is not able to scramble and create a system to track this in 2025. So our recommendation is for anyone who thinks they may benefit from the no tax on tips or the no tax on overtime provision, they probably want to collect all of their pay stubs and give that to their tax preparer in addition to their W-2, because their W-2 may not include that information. Their employer may not offer supplemental reporting, and you might actually have to go through detail by detail throughout the year to say what of this income, if any, qualifies for these tax benefits.
Per your recollection, when exactly did the big beautiful bill and these provisions go into effect? Am I remember correctly that it was around like July?
Yes, but they were made retroactive to the beginning of the year. So it really
Oh,
applies to all of 2025, which obviously puts employers in a tough situation because they've already been reporting income a certain way. And then it's like, oh, we've made a change and it goes back. How do they go back and capture that? That can create a big, costly project that they would have to do to report that correctly. So they were let off the hook in that they're not required to. And a lot of employers may just choose, we're not going to go back to the beginning of the year and spend a bunch of time and money to get that data if we're not required to. So then that really puts the burden on the taxpayer to do it themselves.
Gotcha. In addition to the overtime and tips, is there any other areas maybe people want to be aware of that they should take a look back at their W-2 or their pay stubs?
Well, I mean, there could be other things that, that are no different than past years, right? Of seeing where, where income's being allocated, where deductions are going, and if those should be adjusted. But in terms of changes, I mean, we basically covered the three big changes. The one big beautiful bill extended the 2017 tax cuts and those percentages. So no change there. But the big one was no tax on Social Security, which really didn't follow through that way. It's really a $6,000 addition to the standard deduction. And then the no tax on tips. And then you have, which again, comes with a lot of caveats. And then the no tax on overtime, which is not no tax on overtime. It's on no tax on the additional compensation for overtime. So if you're getting time and a half, you'll still be taxed on that original, regular time. It's the half that gets added that won't be subject to taxes.
Perfect. Thank you for the clarification. All right, let's jump on over to the Plan Solutions Incorporated Office Bulletin Board. 2 items pinned up there. What do we got?
Yeah, so Plan Solutions, we held a all hands offsite. I mean, we were still within the complex, but out of the office to get a change of scenery. We figured new year, it's a good time to, for renewal, to sit down to really discuss our values, what's important to us going forward, and how, our behavior and our actions over the next year can reflect those values. So I think it was a really, positive opportunity of team building, bringing everyone together. I think there will be more that will come out of this, but, we're trying to do some more of those things. Obviously, as the team grows, right, more people, I think it's even more important to get everyone together and make sure that we're all on the same page on occasion.
Yes, sir. And the last item you have pinned up there.
Yeah, so Shannon recently reached an impressive milestone. He's been working with Plan Solutions for 25 years now. So, quarter of a century, which it's hard to believe that we've been working together that long. And needless to say, during his tenure, he's had a big impact on Plan Solutions and our success over that time. And fortunately, he started right out of college, so he's still got a lot of time in his career. My joke was that he's reached the halfway point, right? So 25 more years and he can retire. That might be asking a little too much, but I think we'll still have a decade or so plus to go.
Yes, sir. Yes, sir. Awesome stuff. Congratulations, Shannon. Anything you want to add before we wrap up this edition of the Plan Solutions Incorporated podcast?
Well, just, the same thing we say every year at this time, right? Tax season's right around the corner. I know people start getting their documents. Important to put them aside in a safe place. You can start kind of drip feeding them to us, or collect them all and drop them all in all at once. Or if people have a question on, what's the best way to go about it, by all means, give us a call or send us an email. So we're as prepared as possible as we head into the busy season.
Yes, sir. And of course, all the information, phone number, email address is all in the podcast description. With that said, thank you for listening to the Plan Solutions Incorporated podcast. Hit that subscribe button on whatever platform you're on if this is your first time listening, or we have a YouTube channel, youtube.com/@plansolutions, where you can listen along while watching the personal financial review on screen, the written content that we discuss here. And if you'd like to read and subscribe to the personal financial review, it's simple. Simply send Katie an email. It's KATIE @plansolutions.com and get subscribed today.
The views and opinions expressed in this podcast should not be construed as an offer to buy or sell any securities. The information may not be current, and Plan Solutions has no obligation to provide an updates or changes. Plan Solutions does not make any representation or warranty as to the accuracy or completeness of the statements or any information contained in this podcast, or any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed. Plan Solutions is not providing any financial, economic, legal, accounting, or tax advice in this podcast. In addition, the receipt of this podcast by any listener is not to be taken as constituting the giving of investment advice by any Plan Solutions associate or individual to that listener, nor to constitute such person a client of Plan Solutions. Any reference to a specific company or security does not constitute a recommendation to buy, sell, hold, or directly invest in the company or its securities. Market indexes are unmanaged and cannot be invested in directly. All price references and market forecasts correspond to the date of this podcast.
Plan Solutions is a registered investment advisory firm.